Hi, good afternoon, everyone. My name is Ku Lee. I am the Director of Targeted Outreach at the Department of Financial Protection and Innovation, also known as the DFPI. Welcome to the webinar. I know it's right at noon. I want to give everyone another minute or two to get logged in. I know everyone is probably just getting off lunch or getting into lunch, and then it's right at 12. So let's be patient for a minute and wait for another minute. Okay. Thank you. Okay, hello and welcome, and thank you for joining us, everyone. Let's go ahead and get started. Again, thank you for joining our webinar. This is part of the DFPI's Financial Education Series. Again, my name is Ku Lee. I am the Director of Targeted Outreach at the DFPI. For this webinar, it's covering building, maintaining, and improving your credit. We have a special guest. I'll get to her in a second here. Let's just go ahead and get started. So first, I just want to go through a quick disclaimer. For this webinar, all your microphones and cameras have been turned off. If you do have a question, please feel free to submit it through the Q&A feature on Zoom. We do have a dedicated Q&A time at the very end, and we will address any questions that you submit to us. But please feel free to use that feature, ask your questions away. This webinar is being recorded, and it will be published on our YouTube channel. These slides will also be made available to you. So after the webinar, I will be emailing everyone who registered. They'll get a link to the YouTube video as well as a copy of the slides. And finally, if you do have any other questions or information you need to get from us, I have an email that goes directly to my team. It's outreach@dfpi.ca.gov. Feel free to email it to us. All right, let's get started. First of all, want to talk a little about the Department of Financial Protection and Innovation, also known as DFPI. Who are we? What is our role? We are California's licensing and regulatory agency. We license and regulate state financial institutions, products, and professionals. We also conduct exams, audits to ensure compliance. We review consumer complaints, and we pursue legal actions against those who are operating illegally or using unlawful, deceptive, and abusive practices. Another thing we do, which is very important, is to provide consumer awareness presentations throughout California. So whether it's in person or virtually like this webinar, we like to help protect consumers from falling prey to frauds and scams. If you do want to learn a little bit more about all the industries that we regulate, I have provided a link right there. Feel free to click on it when you get the slides, and you could read more about everything we do. Okay. Next, I'd like to introduce our special guest, Melinda Opperman. She is the Chief External Affairs Officer for Credit.org. Little about her: after attending junior college, Melinda graduated from Cal State University Northridge with honors with a degree in consumer economics. She has almost 20 years. She has spent almost 20 years with Credit.org and is a certified credit counselor. She has a weekly blog. She has over 200 media credits in TV, radio, print, and other media. and she loves consumer advocacy. So again, we are very honored to have Melinda here to talk about building, maintaining, and improving credit. Melinda, thank you for joining us. Please take it away.
Thank you. Thank you for the kind introduction. I'm excited that so many people have joined us today. I'm happy to share just a little bit about our organization so that you know who you're hearing from today. So credit.org is our legal name, our legal DBA, doing business as. Credit.org is also our website address. We were founded 49 years ago. We're a nonprofit 501c3 organization. Our full legal name, and some of you may remember us by that, for many years you may have heard Springboard Nonprofit Consumer Credit Management Incorporated. That's still our legal name, but the DBA is credit.org. As I indicated, we're a nonprofit organization. We offer housing counseling, credit counseling, and nonprofit debt consolidation. We also offer student loan counseling and pre-bankruptcy counseling services. We're accredited by the Council on Accreditation. It's signifying the highest standards in governance. We provide housing counseling also. We're approved by the U.S. Department of Housing and Urban Development, HUD, and in that capacity, our HUD certified counselors provide foreclosure prevention counseling. They provide rental counseling, rental default counseling to avoid eviction. We provide reverse mortgage counseling for seniors that seek to age in place, pre-purchase counseling, first-time homebuyer education. You can have an appointment with us one-on-one in a confidential setting. We can help people virtually. We can help people in person also. So keep us in mind if you're needing any type of assistance in that regard. Let's go ahead and get started. On that first slide there, I wanted to share with you what you're going to learn today. So your credit history is your financial DNA. Who are the credit reporting agencies? What's in your credit report? And how is your credit score calculated? We're going to discuss some tips for building, maintaining, and improving your credit. And we're also going to talk about what your free credit report says and doesn't say about you. Next slide, please. So as I indicated, your credit history is your financial DNA. There have been studies in the past and even recently. One I like to highlight is the one mistakes do happen. There's a 1 in 4 chance that a credit report could have a serious enough error to cause you to be denied credit, a loan, an apartment, a mortgage, even a job. So it's very important to look at your credit. Next slide, please. So the credit reporting agencies, there's 3 of them: Equifax, Experian, and TransUnion. So be familiar with those names. Again, Equifax, Experian, and TransUnion. Those credit reporting agencies are different than the FICO name you may have heard of. FICO is a credit scoring methodology, which stands for Fair Isaac Corporation. And Fair Isaac Corporation looks at the data, the trade lines in those 3 credit reports to provide the credit score. Next slide, please. So the 5 factors that make up your credit score are there on the slide. Looks like a sliced up piece of pizza. The largest one that makes up your FICO credit score is payment history. 35% of your credit score comes from payment history. The other 30% is amounts owed, and that's what we call utilization. And what that is evaluating there is the amount of your balance on your credit card to the credit limit you have on the card. The next category is credit history. That is 15%, and that is like the length of your credit history. And we're going to talk about that in a bit. So credit history is how long you have had an account. New credit, 10%, that's talking about getting inquiries. For example, too many inquiries can lower a credit score because it shows a high propensity to want to take on new credit. Now, keep in mind when I'm mentioning the inquiries, there's two different type of inquiries. There's hard inquiries and there's soft inquiries. So a soft inquiry would be like an inquiry that a consumer credit counseling agency like credit.org would pull. Or maybe your insurance carrier needs to look at your credit information. They would pull a soft inquiry. A hard inquiry is the one where you're filling out an application, wanting to take on a line of credit. That is called a hard inquiry. Those are the ones, if there's too many of those, it could lower a credit history, a credit score, so to speak. Types of credit, 10%. That's looking at the types of credit you have as far as installment accounts versus revolving accounts. Do you have credit card debt? Do you have an auto loan? Do you have a mortgage? So it's looking at that type of situation for that portion of the score. And I also want to mention here, because sometimes people say, oh, I've heard of this thing called Vantage Score. Yes, Vantage Score is a competitor, so to speak, to FICO. 90% of the companies pull a FICO. Vantage Score is not pulled as frequently, but I do want to mention that I am aware of it, and they have a similar pie slice as this. They actually introduce a little sixth sliver, but same scoring as far as the score will go from 300 up to 850. And you may remember in the past, oh, I remember that Vantage Score used to go higher. It did. And because of consumer advocates saying, look, this was getting confusing to the consumer, they went ahead and synced up with the same scoring level of a 300 to 850. Next slide, please. So building, maintaining, and improving your credit. The key thing here is on-time payments and keeping the revolving credit balances low. That's being measured to your credit limit. And that is how likely you're going to be able to pay your bills in the future. It's considered a way that they can predict or assess risk. So a big part of the FICO scoring model, from our perception as a consumer credit counseling agency, because we don't represent their brand, but as a consumer credit counseling agency, the way we look at that is the likelihood that you are not going to be able to pay a bill in the future. So what FICO is looking at is they look at what is in your credit report for the past, and they use that to predict what is the likelihood in the next 2 years that you are going to be 90 days or more delinquent. And they do that assessment from the trade lines that are in the credit report. So the trade lines are the individual entries in the credit report. One of the things that, in our opinion, FICO relies on a lot is revolving credit cards, which is different than your installment loan, your auto loan, your mortgage. Installment loans, we pretty much don't forget to pay. Lots of times they're even set up as automatic debits out of our accounts. But revolving accounts, we feel there's some secret sauce there from our perspective, because there seems to be a lot of weight placed on your revolving credit cards. And reason for that from our perspective is you shop with that card, and you have to remember, I use that card. I have to remember, did I get the bill, whether it's snail mail or an online bill reminding me? I have to remember to budget to be able to afford to make that payment, and I need to make that payment on time. Keeping your older revolving accounts active, using them at least once a year is really important. That's that link to credit history I mentioned earlier. So if you have an older revolving account, be sure and use it like once a year, pay it off right away so that you don't accidentally lose what we call that trade line. Because if the account goes inactive, for example, after 2 years, they may think you don't want to be their customer anymore, and they will then close the account. Getting credit when credit is due. So in the next couple of slides, I'm going to give you the address for how you get your credit reports for free. Make sure and look through there and make sure you're getting credit when you have an account. Make sure it is reporting the history on the credit reporting agency. Years past, I remember a young adult daughter had an auto loan, and we realized it wasn't appearing on her credit reports. So we reached out to that credit furnisher, so to speak, and asked that they report that on her credit history. Another thing I like to talk about as far as improving credit can be getting a secured credit card. Perhaps you're new to credit and you've been being denied the ability to get a credit card. Getting a secured credit card could be a great way to get on the credit scoring radar, so to speak. And a secured credit card is placing a small amount of funds, sometimes $500, with a major credit card issuer, brands that we're all familiar with, and they will then give you like what we would call a starter credit card. And the credit limit will be $500. Sometimes you may want to make a larger deposit up to $1,000, and you'll use that card, and please pay it off in full or make several payments as your budget can permit. But the goal is then to show that you can handle that account positively. And then typically after about a year, the card then converts to unsecured and they return those funds to you. Also, limit the number of inquiries for unsecured credit. And I wanted to clarify there, unsecured credit. So that's going out and getting your department store cards, your major brand credit cards, MasterCard, Visa, American Express. Limit the amount of inquiries there. If you try after a couple of times and you don't get the card, let's do a deep dive in the credit report and find out why. If perhaps it was due to a thin file, which is what happens when you have insufficient credit, so to speak, then let's go the secured credit card route, or go with a card that's a little bit easier to obtain, perhaps a gas credit card or something to that effect. Those will be sometimes easier to obtain. Also, another thing that young adults can do is sometimes when they are invisible, so to speak, on the credit reporting agency's radar, they can ask to be an authorized user on a parent's credit card. So that's something to keep in mind. The account will show up on the credit reporting agencies. There's a column there and it'll show like, are you a joint card holder? Are you an individual card holder? And that'll show as an authorized user. All that credit history from your parent or spouse that's perhaps had the card for a while, that's going to then show up with all of that length of credit history. And that can really help in that regard. And then I'd like to mention here about post-bankruptcy filers. If you've had to have a bankruptcy filing, administrative relief to handle past debt, consider doing what we call a bankruptcy relist on the credit report. And what that is quite often you'll have a lot of accounts that were discharged in bankruptcy still showing as collections and charged off. And in a few slides, we're going to get to a book that we have for free on our website. And there's a whole section in there on how you can do a bankruptcy relist. There's no need to pay anyone to do these services for you when you can do them yourself at no cost. And then I also have a section in the book that's called a 100-word consumer statement. And that's where you can explain something on your credit report. Let's go ahead and go to the next slide, please. So your credit score is based on the information in your credit file. It takes into consideration the positives and the negatives in each category. And your credit score has, quote, no memory of the last score. So let's say a few months ago, you had your credits pulled and you heard or understood your score was low. But you then were made aware that there was information on your credit report. Like I mentioned early on, what if you were one of the 4 with something on your credit report that wasn't yours, or a mismerged file, a junior senior file, and that now has been removed by the credit reporting agency? Please know there's no memory by FICO of that your score before was a poor score. So that's very favorable to consumers. And then if you have a long and ugly credit history, so to speak, your score is going to be weighted in favor of the latest performance. So it's really important here to turn over a new leaf, so to speak, and rebuild your credit history. As I mentioned, we provide pre-purchase counseling, first-time homebuyer classes, and sometimes we have people that had a financial setback in years past, but they never got back on the credit horse, so to speak. So the only thing there in their credit file, on their credit reports, is some past negative information. So what they need to do now is let's build the positive, whether it's with the secured credit card or getting, a small account with a department store or a gasoline fuel card, so that now you'll have positives on the credit report. The scoring model looks at the last 2 years and really weights that heavily. So you're going to get positives, and those positives are going to offset the negative, and it's going to bump the score up. Again, it takes time. It can be a year or so, but this is the method that you want to do. Please do not use the credit repair companies that are for-profit companies that have monthly fees, and they just simply do what we call frivolous bombardments of the credit reporting agencies. Don't get into something like that in an effort to improve your credit. Do it yourself and follow the suggestions and the counseling that we can provide you. So again, reestablishing positives to offset the past negatives. The negative information, as I already mentioned, seasons out. Once it gets a couple of years old, you begin to utilize credit responsibly, you can improve a negative score. So next slide, please. So I want to talk a little bit here about the zombie debt and the junk debt buyers. Zombie debt is a name that the Federal Trade Commission gave this debt. Here at credit.org, we call it junk debt buyers. And this is something that I really also want you to keep in mind on a way that the DFPI can help you here. What can happen is you can have a old bad debt that's, many years ago. In fact, I worked with a consumer yesterday. This bad debt was from 15 years ago from a disputed cell phone bill. That balance was then purchased by a junk debt buyer. So they bought this $500 disputed cell phone thing from 15 years ago. They bought it for cents on the dollar, and they put it on the credit report like it's a brand new debt. So if you have things like that you find on your credit report, if you're working with the company, be sure and ask them, send me a bill. Send me a letter. Don't get engaged with anything on the phone with the junk debt buyer or zombie debt company. Don't make promises to pay or anything like that until you get the specifics about the account. Request verification of the debt. They have to provide this in writing. Don't provide personal information. Consumers sometimes, with the intimidation of these collection practices, they will say that we need a payment from you immediately, and then they'll access your account and start to make future debits. So you have rights under the Fair Debt Collection Practices Act, and if you feel your rights have been violated, please be sure and file a complaint with the DFPI. Next slide, please. All right, so here is where you're going to be getting your free credit reports. It's there on the slide, annualcreditreport.com. You can log in. If for some reason you don't want to log in on the internet, you can also call that toll-free number. Please know that is a phone number that was set up by the government to provide to you your free credit report. So you can feel very confident when you are leaving your information there of your name, your social security number, and your address, and they will mail you your reports. Scores from that site are not free, they're nominal. I placed here on the slide in the middle 3 different places where you can get your credit score for free. They're going to want to advertise to you, perhaps to get a credit card and look at their products. But those 3 sites, creditkarma.com, creditsesame.com, and mybankrate.com, are all legitimate. And I like to let people know that because that's always a top question. There's also Experian Boost and Experian Go. You may have heard about that. That is where consumers can opt in. You choose to opt in to have Experian Boost log in to check with your participating utilities, your video streaming services such as Netflix, and your rent provider if your property management company participates. And that can then be added if you choose to opt in to your Experian credit file. So that can help with the credit invisible and thin files. And again, it is for free. Next slide, please. So that's the book I was talking about. Down there on the corner of the slide, it indicates that you would go to our website, credit.org, go to financial resources, educational guides. There's a download section, and you can download that book for free. Next slide, please. Here's the information on how you can contact us. Our email address is education@credit.org. We've also provided the actual live link if you want to link in to schedule an appointment with us. And then displaying on the screen there is our QR code. You will then go into that location. You would then register. You just put in some information about yourself and then the type of credit or housing counseling appointment you would like to have. And then our phone number is also there. It's 1-800-WISE-PLAN. And the digits when you spell out WISE Plan is 1-800-947-3752. I think we're ready for some questions.
Perfect. Thank you, Melinda. A lot of really fantastic information. We have so many questions. Questions that were submitted to us through the registration process, and then others that were just sent to us in the Q&A. Just a quick reminder again, everyone, if you do have a question, please put it into the Zoom Q&A feature. We're going to try to get to it if we can. Melinda, did you see any questions that you want to answer right off?
Let's see. I haven't used a store's credit card in 2 years, and the store closed the card. So as far as being affected negatively, what that is indicating is that you just have less cards for them to assess in their methodology. It's not going to punish you, so to speak. It's not bad credit. But again, what can eventually happen is if you only have a handful of department store credit cards or something to that effect, it can end up where you start to not have any trade lines to score. So my feeling is you pretty much only need about 2 credit cards, and then use them at least once a year or to pay like a reoccurring bill that we all typically have in our lives. And then just remember to pay that off every month in full. And one of the other questions that had come up was about the interest rates. I'm not too concerned about interest rates if you're paying your cards off in full. There's a myth out there with credit cards. Oh, I got to keep the balance, a small balance at all times. No, that's a myth. You just have to use the card, pay it off in full is our feeling, or perhaps maybe you bought a set of tires and you need a few months to pay it off. But the goal is to pay your card off in full every month so you don't incur expensive finance costs. So an example of a secured credit card, you can go to bankrate.com that I was on an earlier slide, and they will provide you a list of many legitimate financial institutions, names that you will recognize, household names, so to speak. And you will then deposit money with that reputable FDIC insured bank, and that'll get you started on a secured credit card. Also, many of us in our own backyards have trusted credit unions that we've worked with. Credit unions are also a great source of getting a secured credit card. A HELOC loan can affect a credit score. So on the HELOC loan, that's a home equity line of credit. That HELOC is not looked at in the same way as the revolving credit. So it's the revolving credit where the utilization really comes into play. And reason being is your home equity line of credit is a secured credit line where the credit cards are unsecured.
Hey, Melinda, so here's a question that seems to be popping up a lot. Can I maintain my credit score if I don't use credit cards? And is it good enough that I just got approved for a credit card?
Okay, so just got approved for a credit card. Perhaps that means you're kind of new to credit, so to speak, and you'll need to at least have 6, preferably 12-month length of credit history on, perhaps that's the first account you've gotten on your credit file, so to speak. So it's not going to be scoreable until you've had that account at least 6 months, preferably 12 months. And the thing on using the cards is like, it's going to be hard for FICO to predict your ability to repay accounts if they don't have anything to look at in the past. So in no way am I advocating taking on a bunch of unsecured credit and carrying a bunch of credit card balances. I'm in no way advocating that. A new thing that's also coming and is kind of important, and I wanted to mention that, especially with the DFPI funding us with a Money Smart program with a grant, we promote bank on accounts. If you have had a barrier and you have been unable to get a credit account, a bank account at a financial institution, please let us know. Because in the future, mortgages with your opting in will be able to look with your permission at your bank account history and almost create an alternative credit score by looking and seeing your reoccurring bills that are happening. Rent, perhaps you pay monthly for child's daycare, things like that. So that's another reason you want to be banked. So no way are we advocating a bunch of credit cards.
Okay, Melinda, first, I know we're right at 12:30. I think we should keep going with a lot of these fantastic questions. I do want to say thank you to everyone who joined. If you need to log off, because I know it's a 30-minute webinar, please feel free to. We're going to continue to answer a couple more questions. And then any questions that we don't get to, we're logging them, and Melinda has a team, a staff that we will send it to, and they will answer your question as best as they can. Here's one that I kind of see a lot of. I know I no longer have a mortgage on my home. Will it negatively affect my credit?
No. And congratulations. Perhaps that means you are living in the home debt-free. That is really something that we all strive for. Here at credit.org, as a HUD-approved housing counseling agency, having a home paid off free and clear is going to be critical to future dignified retirement, so to speak. So no longer having that mortgage. Again, that was an installment account, not a revolving account. That in all likelihood could remain up to a decade on your credit file. They don't fall off quickly.
Okay, great. Thank you, Melinda. Following up with that, and this is another question I'm seeing a lot of, is how can I buy a home with a low credit score? It continues on and says, I've paid my debt to income down, but do I need any down payment assistance? So probably the main question is just how can you buy a home with a low credit score?
Okay, on a low credit score, we'll kind of want to look at that as far as how low is low. There's different tiers of being low, so to speak, but just in general, as a HUD-approved housing counseling agency, we are proud to mention the FHA mortgage, the Federal Housing Administration mortgage. It's a mortgage that is for first-time home buyers, and FHA will allow you to apply and often approved with all other things being considered, like income, can qualify for the home. With a credit score as low as 580, that will require a little bit more of a down payment, typically about 10%, or FHA can go as low as 620, and they'll be looking at about 3.5% down. So there are programs for you if you're in that situation. We would want you to attend one of our first-time homebuyer classes and also go through our pre-purchase counseling. There's no cost to go through our pre-purchase counseling. We will, in effect, pre-qualify you for a home loan. We're not a lender, but we will help look at all those credit scores, help with how your funds should be seasoned so that they've been in an account long enough, help you with things called DTI, debt to loan ratio. So I think I've answered that.
Perfect. Thank you, Melinda. Let's do a bit of a lightning round. I know some of these might need a longer answer, but let's try to answer them quickly if we can, just because we have so many. Okay, this is one I see a lot. Is your credit score affected by your spouse's?
Not if the spouse's account is in their name only. So if your spouse has an account that they acquired on their own, it would be the I individual. You aren't a joint applicant and you weren't put on their card as authorized user, it won't affect your credit. If perhaps you were put on your spouse's account as an authorized user, you can contact the credit reporting agencies and ask to have that removed from your credit history because you're not contractually bound to it. So no, your spouse's credit history wouldn't affect you there.
Okay. How can I check to see if I have any zombie debt?
You're going to want to pull those credit reports from annualcreditreport.com. The online tool is fantastic. You can actually click into each and every one of your accounts. If you have a collection account there's another field you can click in. They'll tell you who the original creditor is, and that'll help you know if, oh, this was an account from many years ago.
Okay. Is there a difference between having store credit cards or major credit cards? Any kind of negative effect?
No.
Great. That's fantastic. I want to close multiple accounts that I've paid the debt off. Is there a best way to do that?
Thank you for asking that question. So in my opinion, I would say the card that you have had the longest of all those cards, that's the card I would keep and plan to keep. The other cards, I would go ahead and close those off. However, if you are getting ready to apply for a mortgage, I would wait and not do anything until the mortgage is handled and working with your lender in that regard. We've had people that are getting ready to apply for a mortgage and they'll go out and purchase a car, which then now affects debt to loan ratio, or they'll get a bunch of inquiries and that can lower credit score. And this is a perfect place to mention, when you are applying for a mortgage or an auto loan, please know you can have multiple inquiries and it won't lower your credit score. FICO did not want to punish you for comparison shopping. So they will bundle all inquiries that are similar for mortgage or auto. They can tell by a specific field and they will treat it as one inquiry, and they'll even disregard the inquiries for the last 30 days. So please be confident and know, comparison shop, look with 3 different mortgage companies, getting an auto loan, check with 3 different lenders for that.
Perfect. Thank you, Melinda. So 2 more questions. At what age do you recommend individuals begin checking their credits or credit reports?
Well, we've had situations where we have had minors, and we'll say like starting like 16, getting first job, they're still a minor, they're under 18. And we've asked them to go ahead and check their credit. They'll need to have a parent write in with them and they can ask. And the reason that is being done is sometimes they're concerned that someone may have gotten access to their social security number and applied for credit in the minor's name, almost assuming their identity. So you could start looking before you actually turn 18.
Great, great answer. Here's one that's kind of interesting. I have a low credit score right now. Should I file for bankruptcy and start over, or is it going to take too long to rebuild that credit?
Okay, so bankruptcy. So you, and I'm not an attorney, I'm a certified credit counselor. So you would definitely want to talk with an attorney about anything in considering bankruptcy. There's now what's called means testing. So they look at income, what's the amount of debt you owe, what's the type of debt, and they will determine if straight bankruptcy, Chapter 13 bankruptcy, what your options are, how much is the debt, what's your income look like for future. Some of the debts may not be dischargeable in a bankruptcy. Again, I'm not an attorney. I'd let an attorney answer that for you.
Okay, thank you, Melinda. One more, I do see a couple of duplicates of this question, so this will be our last question. So I'm getting close to paying off my debts, whether it's an auto loan or credit card, whatever it is. Will reaching the end of that loan or paying off that debt have any negative effects on their current credit score?
No, because that's that installment credit. So paying off that auto loan, that's going to stay on your credit history, so to speak, for a long, long time. So great. Congratulations on that.
Okay, and I do want to thank everyone who asked a question. I know we didn't get to all of them. There's so many great questions that was submitted to us live, and then also during the registration. I will forward these questions over to the ones that we can get to Melinda's team. They'll do their best to answer them and get back to you. With that, I do want to just talk very quickly and say, the DFPI has more financial education webinar series. It's a monthly series that we put out. Subscribe to our newsletter, which gives you information about upcoming webinars, other events, consumer alerts. So be sure to subscribe to us. Here's a couple of links to our social media profiles. Feel free to connect with us on social media. And again, next month's webinar is how to pay for college. So if you have kids or students, or you're going through that yourself, please feel free to register for this upcoming webinar. It is on April 19th at noon. And we'll have a link there so you can click on it and register for that webinar. Again, I want to thank Melinda for joining us. Credit.org is amazing. They do great work. And thank you everyone for joining us and attending the webinar. Please take care of yourselves and each other. Thank you. Have a great day.